Good afternoon, everyone. Great to be with you again. And we're just squeaking this in before I head off on vacation. I'm Brad Macbeth here with the Simple Plan Live. It's great to be with you. And we're going to get right down to it because today we're going to delve into one of those questions that plagues people. And I just want to kind of give you some insight into how it's not nearly the simple question you wish it would be. And that is, well, as you know, we've been looking at how we build financial plans and what that looks like. So we're going to drill down deep into that on the RRSP and TFSA, Registered Retirement Savings Plan Tax-Free Savings Account front today. So just want to remind you that you can find us on Facebook. We love to have you follow us there at Macbeth Group on Facebook. And you can also find us on Twitter at Cash Coach Canada and on Instagram at Macbeth Group. I want to thank our sponsors, the Simple Plan Life Insurance. You can get your free, complimentary, wide-ranging quote of life insurance options from all major Canadian insurers at getthesimpleplan.com/quotes. You can also figure out how much life insurance you should be carrying at getthesimpleplan.com/how much. And it's really worthwhile doing that right now. I just want to add this bit because there's some really interesting things going on. One of which is that prices are lower than they've ever been, primarily because they've been dropping for a long time, due to competitiveness, also due to improved healthcare. People don't die as much as they used to at these younger ages. So prices have been going down in life insurance, but they're going to start going up. It really looks like. In fact, a few rates have started to go up already. I expect many more will over the next 4 to 8 months. That's because interest rates are so low and insurance premiums are sensitive to interest rates for a whole bunch of reasons. So it's a great time. Another great thing is right now you can actually get life insurance more simply than you've ever been able to before because they're not sending people around to your house necessarily to draw blood samples or get urine samples, that kind of stuff. So it's easier and cheaper to get life insurance today than it's going to be again. So check that out. You might save yourself some serious money. Today's, we always like to have a helpful article or tool. Today we have a tool, the Simple Plan Retirement Calculator. That's at bit.ly/SP Retire Calc. You can go there and you can check out how much money you're going to need to accumulate, what your nest egg is going to be to retire in the lifestyle you want to. And based on that, figure out how much you're going to need to save between now and that glorious date of retirement. So that's the Simple Plan Retirement Calculator. You can find that at bit.ly/SP Retire Calc. So I appreciate you being with us today. Again, my name's Brad Macbeth, and I've been doing this for about, I think it's 18, 19 years now. So today we're going to dig into one of those questions that didn't exist when I started, but has been plaguing us since the beginning, since 2009, and that is, should I put my money in an RRSP or a tax-free savings account? Now, I'm not going to give you the definitive answer on that because there is no such thing as a definitive answer on that. This is a long-range, a very long-term tax planning question. For some people, it will be quite clear one way or the other. For others, it's really a depends on answer. But I want to show you why that is. And this will especially show you why you need to have a real financial plan, because this is where these decisions get made in wisdom and in context and in a clear understanding of the long-term implications of these choices. I see people asking all the time in things like Facebook groups of, well, should I put my money in an RRSP or TFSA? Well, listen, a lot of people are happy to give you an opinion on that. And what you'll find is that almost none of them ask any background questions, and yet they have a big opinion on it. There is no way to answer that question well without doing a very detailed analysis of your particular situation. So let's get right down to it. Those are our results. What I want to show you is how we get there. All right, so you'll remember this, I think, from our our last episode, we kind of entered some information here. This is our financial planning software. This just happens to be the one that I use. There are many out there. This one, I think, produces useful information without drowning you in details. Now, it's probably looking like there's a lot of details there on the screen, but that's just the calculations it produces. So we have this person set up so that they've got income, they've got an investment account. We're starting out with them at 35 years old. They're going to retire at 65. They've got some debt. They've got a mortgage. They've got a house. Fairly standard kind of stuff. They're making $65,000 a year in taxable income. So I wanted to, last time we built some of this, and I want to show you. Let's click in to look at the asset, the investment that this person, that Jen has. So Jen, 35-year-old Jen, has an investment that's $37,500 currently, and that is a registered retirement savings plan. She's also got a real asset, which is a home at $450,000. So again, fairly straightforward, simple stuff. We won't be changing our rates of return on this to show you what it is we're going to show today. So all these things, except one, are going to stay the same. So if we go back to our planning page, it's always interesting to scroll down and have a look at the results. So age 35, again, we're projecting age 65 for retirement here. And so we start to see, well, how much is Jen going to be able to live on? All right, and so we've got $56,945 here. Now, again, we talked about last time the difference between real dollars and nominal dollars. Nominal dollars is the actual money you're going to have or spend or what have you in the future because of the effect inflation is going to have. Of course, our nominal dollars are just a projection because we're saying, well, let's pretend that there's going to be 2% inflation or 2.5% or what have you. We don't know the answer to what that's going to be, but we can plan for that number. Real dollars means that that's getting adjusted to today's dollars. So you can compare apples to apples. How much do I have to spend today versus how much am I going to have in the future? And so, there's all sorts of numbers to look at here. You can see where retirement is. Retirement here is where employment income stops. And among other things, CPP and OAS begins, and other things go on as well. We start drawing money down from our investments as opposed to contributing. You can see here in this yellow highlighted column that Jen is contributing to her investments over the coming years. All right, so what I want to do is show you how the results can vary. So just to clarify, all I have done to demonstrate these two different results is I have changed the asset type from RRSP to tax-free savings account, because that's the question everybody wants the answer to. Should I invest in an RRSP or a tax-free savings account? And of course, the answer for you might be, well, both. Either max out one or both, or put some in one and some in the other, or what have you. But I want to show you, this is the main thrust of today's conversation, why this is such an interesting and challenging question. So let me show you here. What we have is the results. I've just taken images of a snippet of the results from both. So on the top here, you'll see it says figure 1. The graphic on the top, this table, is RRSP. And the graphic on the bottom here is the tax-free savings account investment. So that's all that's changed. In the top result, Jen's investments were all put into an RRSP. In the bottom result, Jen's investments were all put into a tax-free savings account. Now, I'm not speculating on anything else. We kept the rates of return the same. I'm not saying that Jen's going to have all the room she needs in the tax-free savings account, et cetera, et cetera. This is purely hypothetical, and this is one scenario that applies to a particular circumstance. So please do not take this and go out and make decisions about what you should do. This is to show you some of the results that can happen and why this is a long-term tax planning question. So what we have here are the 4 rows, the last 2 years that Jen's working and the first 2 years of her retirement. So how can we tell that? Well, we look over here in the employment income column. All right, so we've got the employment income there. You'll see that we have 2 years of employment income, and then employment income goes to 0. And I would say the number one consideration we all want to be making is, what is the after-tax spending going to be? That's what we really want to know in retirement. 2 things. How much am I going to be able to live on in retirement? And am I for sure not going to run out of money? And so we use our software to optimize and I'll say levelize the amount of money that people are going to be able to live on through their retirement. Again, in real dollars. So you'll see that the in real dollars number is varying while she's working, but once she's retired, we now have got that consistent. And so after-tax spending is the number that we're really after. So we have a look over here, what's happening on the CPP and EI front while she's working. She's making, in the $9,000 range in terms of CPP and EI contributions. Remember, because you can't make that level of contribution now, that would be very high. That is projected forward, adjusted for inflation. And that's 30 years from now, because Jen's 35 and retiring at 65. So we're projecting that based on her income, she would be paying income tax, or total tax, if you will, of about $19,000 in her last couple of working years. And remember, in this top one, she is making a contribution to her RRSP. Now, let's look at the bottom one. We've kept everything else the same, and we want to know what's going on here in the after-tax spending department. And so, what's the difference? Well, let's go look over here again at the total tax. Now, it's interesting, isn't it? Jen is paying more tax while she's working these last 2 working years, even though her income is the same. Her employment income is the same in those 2 years. She's paying more tax. Well, why is that? Because she made RSP contributions in the top illustration, and she made tax-free savings account contributions in the bottom illustration. So note the effect that has. Her after-tax spending over here, while the last 2 years she's working, $38,000 and $40,000 versus $37,000 and $38,000 when she's contributing to a TFSA rather than an RRSP. So her after-tax spending while she's working is a little less. However, let's look at the tax that's getting paid when she retires with all her money in a tax-free savings account, and of course some coming from CPP and OAS, which we see there. She's paying $57 and $51 in tax once she retires, and enjoying significantly more after-tax spending money. $56,000, $56,945, so almost $57,000 versus $48,000 if her money were all coming out of an RRSP. Now, let me say a few things. This is a very simplified scenario. She has one investment account that's either an 100% RRSP or 100% tax-free savings account. I can't even say that this is the most tax-optimized scenario. It may not be. And what do we mean by tax-optimized? Tax-optimized means we have reached the happiest equilibrium that we seek in after-tax spending, available after-tax spending, both pre and post-retirement, before and after retirement. That's the real question that we're asking when we say, should I put my money in a tax-free savings account or an RRSP or even an open investment? What we're really asking is, and most people don't know that's what they're asking, how can I optimize my tax-free spending both before and after retirement? And it's not a question of, it's not an off and on thing. It's more like a slider that you adjust, that one affects the other, right? So you could maximize your after-tax spending pre-retirement and really hammer down your after-tax spending post-retirement. Or you could go the other way. You could live very, very frugally pre-retirement, paying all your tax up front, and then live without paying much tax post-retirement. There are other things that affect these choices as well, which I'm not getting into, but things like clawback on OAS start to come into play at certain income levels. So my main point in all of this, to try to help people understand, is that this RRSP versus tax-free savings account question it's a huge question. Number one, we can see here it's a $9,000, which is almost a 20%. It's about an 18% difference in after-tax spending pre-retirement versus post-retirement for this individual in this example. Now, in this example, that means this person is spending more money in retirement than they were spending while they were working. The conventional thinking when the RRSP program was invented was that people will spend less when they retire. Can't say that that's necessarily what people want to do. And I think increasingly it's not how a lot of people are behaving. If they're able, they'll go spend. People like to travel. Of course, we're not able to travel right now, but people like to travel. People perhaps like to give to family members or to causes that they care about, and do all sorts of things with money in retirement that they might not do nearly as much of when they're working because they don't have time or what have you. So it really depends. Now, of course, it's very difficult for people to project, especially if they're a long ways from retirement. It's difficult to project, am I going to be living on more in retirement or while I'm working? But what doing a plan like this helps you to understand is what the range of options are. And the range of options are complex, and they have a significant long-term impact. They have a significant impact on today. Obviously, if you make large RSP contributions today, you're going to pay less in income tax. But if you make large RSP contributions today, you may be setting yourself up for large tax payments in retirement. Again, this is not it's just a fictional example. I'm not saying it's highly realistic. I'm just saying it's an illustration. But ask yourself this question: do I want to pay $19,000 to $20,000 a year in tax in my retirement, or would I prefer to pay $57 a year in tax in my retirement? So when you're asking yourself, should I put my money in a tax-free savings account or an RRSP, you really need to get it going on putting together a plan like this. If you don't have a plan like this going, then you really are just making your choices blind without good information. People want to have a simple principle for if you make this much, then put it in an RSP. If you make that much, put it in a tax-free savings account. Even that doesn't really work, because if you're 35 years old, well, how much income? Well, what's your career trajectory, right? Some people, that's easily known. For example, let's say you're a teacher. If you're a teacher that's just starting out, you're going to make whatever the base salary is. In some jurisdictions, it might be as low as $45,000, something like that. But if you're going to stick with teaching for the next 30 years, that by the time you get to the end, you're going to top out, because that's how that works. That's how that particular system works. And topping out might mean that you're making $100,000 a year, so more than double the income. If you're just starting out as an articling lawyer at age 26? Well, you know that you're going to make a whole lot more money by the time you're 60 than you're making when you're 30. So that's why these questions are big and complicated, and they're very personal. And so when we're asking tax-free savings account versus RRSP, of course we really don't want the complex answer, but we really can't avoid it if we want the right answer for our situation. And that's all there ever is the right answer for a situation. So putting together plans like this is what gives you the information to make choices. And without doing that, you're just kind of flipping a coin. And there's not very many people who I can confidently say, never mind, just put your money in an RRSP, or never mind, just put your money in a tax-free savings account. People at the margins, you can probably do that. You can do that if people are earning quite a low income and don't expect to earn more. Or if they're earning a very high income, you're going to say, well, max out both, and then we'll figure out what to do from there. Because that's a different type of question. So I hope that's helpful to you, because what we're really trying to do with these live shows is to really get across the real questions and how this is done for people making choices, making decisions, making plans about their long-term finances. And the good news is if you take the time to do that, and it does take time, it takes time especially up front to build it, but once you've built a plan, then you have to spend time annually monitoring it, seeing if your assumptions are correct, seeing if your circumstances have stayed the same or changed, adjusting as you go. But by doing that, you can be confident that you can weather turbulent times, difficult financial situations, such as many people are experiencing right now, and also know that your future is well laid out and well taken care of. And you can sleep well at night not having to worry about your finances. So that's all for today. I hope that you've enjoyed this. I hope that it's been interesting to you. We are happy to answer your questions. If you have any questions, if you are interested in a financial plan, you can go to our website, getthesimpleplan.com. And there's actually a button there where you can actually get a basic. It's not a comprehensive plan like this one, but you can get started with a very basic financial plan. So I encourage you to go to getthesimpleplan.com and click on the Get My Plan button if that's of interest to you. So thanks very much. Hope you've enjoyed our program today. Want to thank our sponsors, which is The Simple Plan. You can get your own life insurance quote there as well. GetTheSimplePlan.com/quotes. You can also calculate how much life insurance you should be carrying. GetTheSimplePlan.com/how much. Remember, you can find us on Facebook at Macbeth Group. You can also find us on Instagram and Twitter. You can find us on Twitter at Cash Coach Canada, on Instagram at Macbeth Group. And remember, you can go get started. This isn't a financial plan, but you can get started with just an understanding of how much you might need to be setting aside to reach your goals. Go to the Simple Plan Retirement Calculator. That's at bit.ly, bit.ly/SP-RETIRE-CALC, bit.ly/SP-RETIRE-CALC. That's all lowercase. And using that tool, you can calculate how much of a nest egg you're going to need to accumulate to retire how you want, when you want, and how much you're going to need to be putting away today to make that happen. Thanks very much. Been an enjoyable time with you. Looking forward to, we're actually not going to be on next week, but we'll probably post something. In the meantime, I hope you have a great week. Let us know if you have any questions. We're always here to help. I'm Brad Macbeth for The Simple Plan. Thanks very much.